Americans feel it every single month. The rent goes up. The paycheck stays flat. And the one thing that used to be the finish line for a working family, a house in a decent neighborhood with a manageable mortgage, keeps floating further away. Right now, home ownership costs the average American family nearly half of their entire monthly income. Not a third, not a quarter, half. The Atlanta Fed's Housing Ownership Affordability Monitor shows that owning a median-priced home consumes 47.7% of median household income, a level hovering in the punishing 40 to 50% range for 2 consecutive years. Home prices are up 60% nationwide since 2019. The median existing single-family home hit a new high of $412,500 in 2024. That is 5 times the median household income. The traditional benchmark for an affordable home is 3 times income. America is not closed. What makes this crisis unlike any housing correction before it is the trap that has been set on both sides of the market. Current homeowners are frozen in their properties, terrified to give up their pandemic-era rates and step into a market that would double their monthly payment overnight. New buyers are locked out entirely, their savings eroding, their window closing year by year. The median age of a US first-time home buyer has surged to a record 40 years old, a dramatic increase from a median age of 33 just 5 years ago. This is not a market running hot. It is the controlled demolition of the American middle class through its most cherished financial institution, and the fuse has already been lit. Let us look inside the crisis. Pick up a pay stub. The average American household earns roughly $80,600 a year, before taxes, before the health insurance premium that takes a slice every 2 weeks, before the student loan payment that follows a large portion of those households around like a shadow. Now go to Zillow and look up a house. The median existing single-family home sold for $412,500 in 2024. Monthly mortgage payments on that property hit a record $2,570. To afford it comfortably requires an annual income of at least $126,700, and only 6 million of the nation's nearly 46 million renters can meet that benchmark. 6 million out of 46. The 2025 priced out estimates show that in 23 states and the District of Columbia, over 80% of households cannot afford the median priced new home. This is not a coastal crisis. This is a national one. And the income math underneath it gets uglier the further you look. Households earning $75,000, a bracket that includes teachers, nurses and trades workers, can now afford only 21% of all listings, down from 49% in 2019. Households earning $100,000 have seen their affordable share of the market contract from 65% of listings to just 37%. Since 2019, the income required to buy a single-family home has doubled. Wages, by contrast, rose approximately 32% over the same period. That gap is not closing, it is widening. And as prices rose, existing home sales dropped to a 30-year low. The buyers still in this market are not thriving. They are stretching, white-knuckling their finances, paying a price the system was never designed for ordinary people to survive. Here is why inventory is not going to save this market. During 2020 and 2021, while the Federal Reserve kept rates near zero, millions of Americans were locked in mortgages between 2.5 and 3.5%. Those rates were a once-in-a-generation anomaly, the product of a global emergency, and now those homeowners will not move. The typical US mortgage holder today pays approximately $1,300 per month in principal and interest. To purchase a comparable home in today's market requires a monthly payment of nearly $2,236, a 73% jump. That is not sticker shock. That is a financial wall. A Bankrate survey from 2025 found that 54% of US homeowners would not feel comfortable selling at any mortgage rate available in the current market. Only 3% would consider selling if rates stayed at 6% or higher. Over 80% of all outstanding US mortgages carry interest rates below 6%. Those homeowners are not leaving voluntarily. The median expected tenure in a purchased home has now stretched to 15 years, a dramatic increase from the 6 years typical in the early 2000s. Academic research from the Federal Housing Finance Agency confirms that each additional percentage point of mortgage rate lock-in reduces a homeowner's probability of selling by 18%. Multiply that across tens of millions of households, and you get the inventory drought that is starving first-time buyers out of the market entirely. The sellers who should be feeding this market are handcuffed to their own good fortune, and while they sit still, someone else has been moving very, very fast. Before we go further, if you're trying to figure out what all of this means for your own financial decision-making, subscribe right now. The next few chapters are where this story stops being about the market and starts being about you. Every generation has its villain. In 2025, the villain is not one company or one hedge fund. It is a class of capital that has concluded, with complete rationality, that the broken American housing market is the most reliable income stream in the developed world. Real estate investors, both individual and institutional, bought 1/3 of all single-family homes sold in the second quarter of 2025, the highest percentage in 5 years. The perception is that this is a Wall Street problem. The reality is more insidious. Owners of just 1 to 5 properties account for 87% of all investor-owned homes. Large institutional players with portfolios exceeding 1,000 homes control only 2% of the market. The real competitive force destroying first-time buyers is not Blackstone. It is the local landlord with 7 properties, buying with cash, moving faster than any mortgage-dependent buyer can follow. In Atlanta, the Government Accountability Office found that institutional investors control 25% of the entire single-family rental market. In Jacksonville, Florida, that number is 21%. In Charlotte, North Carolina, 18%. In those cities, a young buyer competing for a starter home is not competing against another family. They are competing against a spreadsheet. In 54% of US markets, purchasing a home now requires a 6-figure income. The investor does not need a 6-figure income to qualify. The investor already has the cash, and with each purchase, one more starter home exits the ownership market permanently and enters the rental economy, where it will generate income for its owner every single month, indefinitely. Psychology is what the housing industry actually sells, not square footage, not school districts. Fear. The fear of being left behind, of watching your peers build equity while you pay rent, of inheriting nothing and leaving nothing. There is a behavioural bias at the centre of every overpriced transaction in this market, and it is doing more damage to household finances than any single rate hike. It is called anchoring bias. The buyer looks at what a home cost 3 years ago, decides that price was the baseline, and concludes that whatever price exists today is still moving away from them. The price is always going up. The window is always closing. Across the US, home values are up 45.3% since February 2020. Historically, home values have grown roughly 4% annually, meaning the past 5 years packed in more than a decade of typical appreciation. And buyers who believe that pattern will continue forever are making decisions that their income simply cannot support. The result is visible in the data. Buyers are entering the market at record high debt-to-income ratios, waiving inspections, accepting adjustable rate products, and stretching into monthly payments that leave no margin for a layoff, a medical bill, or a car breakdown. The median age of the US home buyer has surged to a record 59 years old. The buyers in the market right now are not a fresh generation building wealth. They are older, more leveraged, and entering at the worst possible position in the cycle. But FOMO did not just infect the primary buyer. It created an entirely different class of speculator, and that speculator's house of cards is coming down right now. In 2021, the short-term rental looked like a no-lose trade. Pandemic travel was exploding. Occupancy rates were near 100% in peak markets. Airbnb was reporting record revenue every quarter. And so, thousands of amateur investors borrowed heavily at high valuations to buy properties they planned to rent by the night, projecting the earnings of a global travel boom as their permanent income baseline. Average occupancy rates for Airbnbs fell from 57% in 2024 to 50% in spring 2025. September 2025 bookings were pacing roughly 12% below the prior year. In August, occupancy was down around 10% year over year. the supply of listings did not shrink to match the demand. It kept growing. In Phoenix, the number of listings grew from 5,000 in 2017 to over 21,000 by 2025. The supply multiplied. The demand did not. Nightly rates collapsed. Margins evaporated. Simultaneously, city governments moved. From New York to Vancouver, strict licensing requirements, occupancy caps, and outright bans are forcing hosts to reconsider their entire model, with many choosing to sell or convert to long-term rentals, often at a significant loss for those who bought at inflated prices with high-interest loans. For many hosts who bought during the post-pandemic boom, the math simply is not working anymore. Mortgage rates are higher, insurance premiums have climbed, maintenance and cleaning costs have not eased. The hosts bleeding the most are the ones who most need to sell, and when they do, they add distressed inventory to a market that has not yet priced in how much of that supply is still silently underwater. The political solution to every housing crisis is always the same. Build more. More supply, lower prices, problem solved. It sounds clean. It is not. The national housing supply gap reached 4.03 million homes in 2025. Even under an optimistic scenario where construction increases 50% above today's pace and pent-up demand fully dissipates, it would still take approximately 7 years to eliminate the current shortage. America is not building faster, it is building more slowly. US housing starts fell to a 5-year low in May 2025. The cost of building materials has risen 41.6% since the pandemic. New analysis estimates that tariff-induced higher building costs will lead to 450,000 fewer homes being built over the next 5 years, adding roughly $17,500 in cost per new home. That is not a rounding error. That is an entire city's worth of unbuilt housing erased by trade policy, while the existing shortage compounds underneath it. Labour is the second wall. An estimated 25% of all construction workers in the United States are immigrants. New data estimates that the number of immigrant workers in the US has dropped by 1.2 million in the first half of 2025 alone. Nearly 60,000 home construction jobs have disappeared since December 2024. The skilled labour shortage alone meant 19,000 homes were simply never built in 2024, representing an economic loss of $8.14 billion. The builders know the demand is there. The buyers know the need is there. But between them sits a wall of regulatory friction, tariff cost and missing workers that no amount of political will has yet dismantled. And underneath all of it, a different kind of crisis is quietly accelerating. Most of this crisis is visible. You can see the listing price. You can feel the rate. What is harder to see is what is happening inside the balance sheets of households still technically current on their mortgages but running on nothing, one unexpected expense away from a very different kind of conversation with their lender. Total US household debt reached $18.8 trillion in Q4 2025, marking a cumulative rise of roughly $740 billion during 2025 alone, and a $4.6 trillion increase since the end of 2019. The share of credit card borrowers in serious delinquency reached 12.70% in Q4 2025, suggesting financial stress concentrated in unsecured borrowing. And the secured credit is beginning to move. In 2025, 227,360 consumers experienced a new foreclosure, a 30.6% increase from 174,100 in 2024. FHA loan delinquencies hit 11.52% in Q4 2025, the highest level since Q2 2021. Later stage 90-plus day delinquencies increased by 76 basis points in a single quarter. In the lowest income zip codes, the 90-plus day mortgage delinquency rate surged from approximately 0.5% to nearly 3.0% by late 2025. These are not subprime borrowers from a reckless lending era. These are employed Americans living in zip codes where insurance premiums, property taxes, and cost of living pressures have quietly consumed every financial buffer they had. The shadow inventory does not appear on a listing platform. It appears in bank servicing reports, in delinquency tiers, and in the slowly widening gap between what people owe and what they can sustain paying. Every financial crisis has a single inflection point, a moment where years of compounding stress find a release valve. In 2008, it was liquidity. In 2000, it was evaluation. In this housing crisis, the trigger is not a financial institution or an exotic instrument. It is one number, the unemployment rate. Right now, the housing market is being held together by the fact that most mortgage holders still have jobs. The Federal Reserve Bank of New York has already demonstrated the direct correlation. As local unemployment rates increase, mortgage delinquency rates follow with measurable precision. Mortgage delinquencies are rising fastest in regions where labour and housing markets are simultaneously weakening. The buyers most exposed are the ones who entered the market at peak prices in 2021 and 2022, stretched by FOMO into loans that consume a dangerous share of their take-home. Their emergency reserves, if they ever existed, were burned through on down payments and closing costs. Their monthly cash flow is already subsidised by a credit card balance that grew steadily throughout 2025, with total credit card debt climbing to $1.28 trillion. When the job goes, everything cascades: the mortgage, the car note, the revolving balance that has been filling the gap between income and reality for 2 straight years. Delinquencies of any duration climbed to 4.8% of outstanding debt in Q4 2025, the highest rate since Q3 2017. This is the pressure building inside the pipe. The market has not broken because the pain is still individual. The moment unemployment moves and becomes collective, the ceiling becomes the floor. Every crisis produces a winner. After 2008, it was private equity. Blackstone, Invitation Homes, and their peers moved in on the wreckage, purchased distressed single-family homes at pennies on the dollar, and built an entirely new asset class, the institutionalized rental. They did not solve the affordability crisis, they capitalized on it. And when this market corrects, the defining question for the next generation is not whether prices fall, it is who is positioned to catch them. The early signals are not reassuring. Institutional investors made up a record 30% of single-family home purchases in the first half of 2025. The median age of the US home buyer has surged to a record 59 years old. Millennials and Gen Z are increasingly stuck in the rental market. The largest corporate landlords are pivoting capital into purpose-built rent-only communities, entire neighbourhoods constructed from the ground up to never be sold to a family, designed to extract rental income from the demographic that can no longer afford to buy. A genuine correction would reset prices, restore the price-to-income ratio to something resembling affordability, and give the locked-out generation a window to enter on honest terms. That is the hopeful outcome. The realistic outcome is a downturn front-run by institutional capital, with the balance sheets and the data infrastructure to identify the bottom before most households even know the market turned. The question for every person watching this is the same one it has always been. When the dam finally breaks, who do you want to be? If this video helped you understand what is actually happening in the housing market, subscribe and drop this in the comments. Are you renting, locked in, or holding out? Let us know where you stand. We read everyone. And we will see you in the next one.